corporate framework to maximize mortgages and minimize tax. So who is this for? It's for corporate business owners and real estate investors. So what's the objective? We're going to maximize mortgage financing, and at the same time, we're going to minimize taxes. So I know this sounds boring. So what I'm going to do is just take you what I was able to do since 2015. So in 2015, I had my first kid. So I moved my family out to Langley and we bought this row house. In 2016, I participated in a land assembly in Mission and bought this property. 2018, I moved my family out to Vancouver Island and bought this property. 2019, I recognized what was going on in development out of Victoria, and I partnered with a friend of mine, and we purchased this property. We bought this one, we bought this one, and then in 2020, we bought this, and we bought this. And then 2022, we purchased this one, and then in 2022, we also purchased another one. So from 2021 to 2023, on two of those lots, we built a 40,000 square foot condo rental building. And then from 2023 to 2025, we're now working on a 120,000 square foot condo rental building. So since 2015, 11 properties were purchased, a 40,000 square foot condo rental building was built, and a 120,000 square foot condo rental building is now in the works. Why do I show this to you? Well, one, I'm going to show you how much income I paid myself to do all of this. Well, my income looked like this: $45,000 to myself as a dividend, $45,000 to my wife as a dividend. Because of this, I have a 2% personal tax bill, an 11% corporate tax bill, and we pay $0 in Canadian pension plan. So hopefully this takes this presentation from boring to at least sort of interesting. So how is this possible? Well, there's two things that we're going to go through. We're going to go through the fundamental problem and the framework that also solved that fundamental problem. So let's now go to the fundamental problem. So in your financial life, you're going to have a corporate lawyer, accountant, realtor, financial advisor, residential bankers, residential mortgage brokers, commercial bankers, commercial mortgage brokers, life insurance agents, etc. All of these people are not connected together. But in reality, all of these people are connected together relative to your financial position. And the person that's responsible for connecting all of these people together and making them work together as one is you. But the problem is you're probably not that good at it. So what are some questions that are impossible to answer from a singular industry's point of view? Let's go through some. How do you structure your operating company's income in order to qualify for a 0% down commercial loan for your business? Well, I think first of all, most businesses have zero clue this is even an option. And the short answer is you have to make your corporation look very strong. And this can be designed if you know exactly what you're doing. But who's involved in this question? Here it is. Corporate lawyers, accountant, realtors, yourself, commercial mortgage broker, commercial bankers are all involved in that. How do you get your down payments out of your residential properties in order to qualify for your commercial purchases? Well, this is a balancing act between how much money you pay yourself out of your company in order to qualify for residential properties, and at the same time, how much money you keep inside of your corporation in order to qualify for the commercial loan. Who's involved in that? The accountant, commercial mortgage broker, commercial bankers, residential mortgage broker, residential bankers. How much money do you need to pay out of your company in order to qualify for the exact amount of mortgages you need for this given year? Well, this is the magical question that every business owner should be asking themselves every single year. The reason is that if they pay themselves out too little, they no longer qualify for mortgages. But if they pay themselves out too much, they overqualified for mortgages. And in doing so, they are now paying more personal tax than they actually needed to do. So who's all involved in this? A lot of people. What are the problems with trust agreements when it comes to future residential financing? Well, the short answer is it's a ticking time bomb on the residential side. Banks do not like trust agreements being set up on properties. So who's involved in this? Corporate lawyer, accountant, residential mortgage broker, residential bankers, and yourself. Should I buy residential property in a holding company or my personal name? Well, this is a loaded question because there's probably 3 to 4 reasons why you should and 2 to 3 reasons why you should not. And it's all relative to your financial position. So who's involved in that question? corporate lawyers, accountant, residential brokers, residential bankers, and yourself. If you have a commercial loan, how do you make sure the commercial bank does not call your loan? Well, this is the last thing on planet Earth you'd ever want. If you structure your corporations incorrectly, this actually can happen. Who's involved? Corporate lawyer, accountant, yourself, commercial mortgage broker, commercial bankers. How does a corporate general securities agreement for commercial financing affect your operating company? Well, first of all, a general securities agreement is pretty much like a corporate guarantee. The main issue between lenders is, will the lender only lend on one property where your business is located, or will they lend on the property where your business is located plus other rental commercial properties? Most banks actually only lend on one, which means that you're going to lock up your company if you don't work with the right lender. That's going to allow you to lend on multiple. So who's involved in this? Corporate lawyer, accountant, yourself, commercial mortgage brokers, commercial bankers. How do you structure your joint venture agreements so the banks have no issues with them? Well, the number one issue in joint venture agreements that's missed is the fact that if you own more than 25% of your joint venture, you are required to be on that loan. So you just have to make sure that you actually want to be on that loan, because the bank is going to force it. So who's involved in this? Corporate lawyer, accountant, yourself, commercial mortgage broker, commercial bankers, residential mortgage broker, residential bankers. How do family trusts affect residential and commercial financing? It's got more to do with residential financing than commercial. You pretty much are limiting the number of lenders that will lend to you due to the family trust. Many banks just don't like working with them, so they just don't. So who's involved in this? Corporate lawyer, accountant, yourself, commercial brokers, residential, the whole team. So there's one thing that actually answers these questions, but the reality is it's an entirely different thing to even ask them. And nobody asks these questions. So what's the solution to this? Well, here you are in the middle, responsible for unifying all of these industries together from a singular point of view. What happens if you just put me in the middle? So let's look at my background relative to these industries. Residential mortgage broker for 13 years, commercial mortgage broker for 6+ years, life insurance agent for 22 years. I've dealt with the corporate legal side for 10+ years. I deal with the accountant side all the time for 13+ years. Working with realtors for 13 years. I became a commercial realtor 2 years ago. Financial advisor, I've been working on that side for 20+ years. Residential bankers, I work with 30+ residential bankers. And then commercial bankers, I work with 30+ commercial bankers. But the most important thing out of all of this background that I have is I figured out how to connect these things together and to make all the decisions that you would make from a singular point of view. So now we're going to go through one of the frameworks that I use to do what I do. So in the middle of the page, we have a line. And on the left-hand side, we have corporate income. And on the right-hand side, we have personal income. And when money is made on the corporate side, generally speaking, when it moves to the personal side, it becomes a taxable event and we have to pay tax. So the question becomes, how do we minimize the amount of money that gets moved from the corporate side to the personal side in order to minimize tax? So the first thing we're going to talk about is operating companies. So an operating company that makes less than $500,000 a year in British Columbia will pay around 11% tax, small business tax. From this point, they're then going to have to pay out a dividend to your personal self. The question becomes, how much of a dividend should you pay yourself? Well, you can pay yourself $37,000 as a dividend with approximately $0 amount tax owed. So if you're not getting any income from any source, the minimum dividend you want to pay out of your company is around $37,000, and then the tax bill will be close to nothing. Number 2 is based on mortgage qualifying. And number 3 is lifestyle. Where most people will fit is figuring out the equation of mortgage qualifying. Now, before I go into mortgage qualifying, I'm going to address the old question of, do I pay a salary or do I pay a dividend? I'm going to explain why I personally pay dividends. So why dividends? So the Canadian Pension Plan, or CPP, is based on salary, 50% by the employer and 50% by the employee. If you are self-employed, you pay both. Today, that's around $7,000 a year. Between myself and my wife, that's $14,000 a year. So, but here's the thing, dividends are considered profits from a business and are not salary. Therefore, CPP does not apply. This means if I'm paying dividends, I don't have to pay Canadian Pension Plan. So on top of that, I got no payroll, therefore no remittance. When you pay salary, you can't reverse it. You can reverse the last 2 years of dividends paid, which gives you flexibility in income structuring. You can pay dividends whenever you like, generally at the end of the year. This allows you to choose the exact amount you want to pay yourself. And on top of that, we get a 15% gross up on notice of assessments. So if you pay a $50,000 dividend, it shows up as an income of $57,500, allowing you to qualify for more mortgages. So is there a downside? Yes, no Canadian Pension Plan retirement plan up to $1,306 a month at age 65. No disability insurance up to a maximum of $1,078 a month. Technically, you can just purchase private disability instead to offset that. Now, who should not use dividends? Well, if you're a dependent on CPP for retirement, I would definitely be paying myself a salary. So overall, here's a dividend summary. It's cheap and super flexible. So now we're going to go to mortgage qualifying. So every property you own, you have to requalify every year to qualify for more loans. So basically what this means is if you want to borrow more money, you actually have to qualify for that new property that you're going to buy and all the current properties you already own. So let's go through some math. So here's an income required for a principal residence. And here's an example. We got a mortgage payment, you got plus property taxes, you got your plus strata, you have plus heat. You divide it by your total debt service ratio, which is basically the percentage of your income that you're allowed to use towards paying a mortgage. We'll use a mortgage payment of $3,167 a month, property taxes of $400 a month. There'll be no strata for a house like that, but the heat will be $100 a month, or at least how the bank looks at it. We'll then times that by 12 months, and we'll divide it by 44%, which is the percentage of income that the bank is going to allow you to use to support a loan. So $44,000 divided by 44% equals $100,000 a year. What this means is this property requires $100,000 a year out of your corporation every single year if you're planning to borrow any more money on the residential side. But what happens after this? Well, a lot of people go buy a condo or buy a rental property. So let's look at the math of a condo. So here's income required, mortgage payment plus property taxes plus strata minus 80% of the rental income divided by the total debt service ratio. Let's do the mortgage payment of $2,363 a month plus property taxes of $100 a month plus strata of $270 a month minus 80% of the rental income, we'll assume is $2,500 a month, then times this by 12 months. We then divide this by 44%. We get $8,800 divided by 44%, or $20,000 a year. So what this means is this condo now consumes $20,000 a year of income. And let's say you buy another one. That's another $20,000 a year of income. And then let's say, for example, a neighbor was selling your property and you wanted to buy it because it was so close and you thought it'd be a good idea. So it might be a good property, but probably not that great of a property as a rental. And this property now consumes $50,000 a year of income. So between these four properties, the income that you have to pay out of your corporation now becomes $190,000 a year. And this is the trap of residential financing that no one considers nor has a clue about. The worst I've ever seen is a principal residence consuming $200,000 a year and purchasing really nice properties that are not the best rentals that consume $100,000 a year, then another one that consumes $100,000 a year, and then another one that consumes $100,000 a year. So this person had to pay $500,000 a year out of their corporation to be allowed to borrow a single dollar more. So what does my situation look like? The property that I live in consumes $70,000 a year, and any rental properties that I own are anywhere from $0 a year to $10,000 a year. So that's when I show you my numbers, my income to myself is 45,000 to myself and then 45,000 to my wife, is because we're buying properties that don't consume so much income. So now let's change gears. Let's look at the corporate structuring side of things. So with an operating company, let's assume you have all the money accumulating in your operating company. The problem with this is that it's prone to liabilities, meaning lawsuits. Therefore, what you want to be having structured is a main holding company. And this main holding company owns a percentage of your operating company. The cash flows or the cash sitting inside of your operating company can be sent up to your main holding company as a tax-free dividend. In this main holding company, you'll own non-liability assets, such as cash, stocks, bonds, and insurance. The key here is no real estate, because real estate possesses liabilities. So what do you do with real estate? Well, what we do is we set up another holding company. And inside of that holding company, we purchase our real estate. And we can actually transfer the money that's sitting in our holding company to the real estate holding company for the down payment with no taxes being paid. This is far superior to owning a property in your personal name with this type of money, because this money in your personal name would have to cross this line. And when it crosses this line, it becomes a taxable event. So if you transfer $200,000 out extra that given year to buy a property on your personal side, you're going to pay $70,000, $80,000 in tax that you didn't need to if you just owned it in the holding company in the first place. So what it looks like is you got real estate holding company 1, real estate holding company 2, real estate holding company 3, real estate holding company 4, and etc. But is there an alternative to just owning residential property? Yes, you should also consider commercial. So what's commercial? It's office, industrial, retail, self-storage, multi-unit residential. For example, here's a sixplex. Or how about buying warehouses? What's the difference? Well, the difference is because we're putting commercial financing against the property, the income required amount is not applicable. You can own as much commercial property as you want, and no income requirements from your corporation are going to be required to be paid out to your personal self to support those loans. So for example, the property that we're just completing right now, the 40,000 square foot rental building, down the road every single year will require $0 of my personal income. This larger building of 120,000 square foot rental condo build will require $0 of my personal income. So is there more? Yes, there is. The operating company actually has a superpower. And this superpower, it deals with the operating company's cash flows and its ability to guarantee commercial loans. So for example, you can actually buy commercial property for 0 to 10% down for your business with the operating cash flows of your business. On top of that, it can buy other properties such as warehouses, retail, self-storage, land. So this operating company can provide guarantees against all of your commercial real estate holding companies. Let's review sort of where the maximum values would be on this. One, it's owning real estate in the holding companies and using your operating companies to support it and provide down payments for it. It's using your holding company to store all of the non-liability type assets, paying out dividends versus paying out a salary, and figuring out the exact amount of money you need to pay yourself based on mortgage qualifying, and at the same time focus on properties that get close to 0 or as close as you possibly can. But if you were to really go to the maximum value, let's say you wanted to go to $100 million in real estate, like how is that actually done? It's pretty much this model, but the only difference is you don't buy residential rentals, because residential rentals will never get you to that level. It is only in commercial where this type of stuff happens. But is there more? Yes, there is. If you look at your holding company, there's a bunch of money in it. One of the things that you can do is you can go buy whole life in your holding company. And you can go to a bank on your personal side and get a line of credit based on how much cash is sitting inside of your whole life contract. The banks that will do this are TD, BMO, RBC, CIBC, and Scotiabank. So why do you want to do this? Well, it's a tool to get access to your retained earnings on the personal side without paying tax through lending. So what's the problem with whole life? Well, 1, it's extremely expensive. 2, it's extremely restrictive. But what's the solution? Manulife. See, Manulife came out with a program that allows you to use 95% term insurance with a 5% whole life rider, which will do the exact same thing as 100% whole life would do. So what does this mean, or why is this important? It means now this whole life contract can be set up where it's extremely cheap and extremely flexible. So if you're paying for term insurance and you add a 5% whole life rider and own it in your holding company, you can implement this strategy. Now, is there more? There's lots more. But it's one thing to talk about this, is an entirely different thing to implement it. And that's why I created the Mortgage Manage program. The Mortgage Manage program is very simple. Right now, you are in the middle, responsible for connecting all these people together from a singular point of view. So instead of you being there, you just put me in it. So how does it work? There's 2 steps. There's an initial structure set up, basically year 1. And then step 2 is maintain and implement that structure year 2 plus. So initial structure set up year 1. Here's basically what happens. I request a set of initial documents. I do an initial review and create a set of questions. On average, we spend 2 hours on Zoom analyzing everything. We create 8 to 15 to-dos on average to start. We implement these to-dos over 3 to 4 months. I refer all the correct people to implement the to-dos. I talk or engage the correct people as required, accountants, lawyers generally, and a monthly update on the to-dos are sent till complete. So this is basically step 1 to set you up where everything is structured correctly. Then step 2 is maintaining it. So what's that involved? Well, it's review corporate financials, review personal financials, review real estate financials, review corporate structuring, review with your accountant and lawyer, be available to answer any questions as required. But once this thing is all set up, what happens is that it becomes very easy to match property that you should buy that are relative to your financial structure. It almost becomes like shooting fish in a barrel when all of this stuff is done correctly. And on top of that, because you're no longer buying properties that consume so much of your income, your tax bill decreases quite dramatically. So how much is this service? It's $2,500 a year. Why so cheap? For me, it's just a filter. The people that are actually using this program are dead serious about implementing everything. And for me, it's just, that's who I want to be working with. So what am I looking for? I'm looking for 50 to 100 managed accounts where everyone is structured flawlessly or everything is done correctly, and I'm taking care of this every single year, versus 300 to 400 non-managed accounts where I talk to people every couple of years and I'm basically fixing blow-ups all the time. So if this is a service that you're interested in or you want to talk to me about, email me, robert@robertklein.ca, or feel free to call 778-896-6732. Thank you.